So now that the market's pulling back, right? What should we do? I mean, do we sell everything, go away, come back, trade it? No. I think, it's never too late to start investing, to start with investing. I said not trading. So I'm going to talk a couple of topics about investing, long-term investing, passive investing versus active. And I think you guys will benefit from it. But it's never too late to invest. On these pullbacks, it's actually a pretty decent, opportunity for you guys to get in there. So passive investing versus active investing. I mean, passive investing has become very fashionable over the last decade after the proliferation of ETFs, exchange traded funds, which you can get in and out with very, very low costs these days, such as the SPY, which follows the S&P 500 index, or the triple Qs, QQQ, which follows the NASDAQ 100, where all the action has been over the last year or so. But on a long-term basis, dollar cost averaging works. If you are an investor, trader is something else. Even if you put $100 a month into some brokerage account, right? And then at the same time of the month, buy one of those ETFs. With compounding, it would be really, really decent amount of money in a few years. You guys have to have a long-term perspective when you're doing dollar cost averaging. It's called DCA. So what you do is you will have maybe a trading account, and then you will have a investing account, which I have. So in the investing account, you're buying things to hold for long-term growth. In the trading account, you're more aggressive. You're trading in and out, obviously. I don't day trade. I swing trade or position trade. You establish positions, you trim positions, you risk manage. Those are different things. But over the last 150 years, what has done the best? What investment, right? It's been stocks. Obviously there have been many, drawdowns or some crashes, right? Such as during the pandemic. But every time you get one of these 10, 15, 20% drawdowns, if you're dollar cost averaging, it's not going to make any difference to you, right? At some prices, you're going to buy it at the low. Sometimes you're going to buy it at the high. But all you're doing is creating a nest egg, creating this fund that will grow, and you reinvest the dividends, obviously, which I'm going to talk about the next subject. Because what should we do now? Should we play defense, or should we dollar cost average? I think a lot of people, when they get into active versus passive investing, they kind of mix it all up, right? They get into ETFs such as SPY, the spiders, or triple Qs or IWM, and then they decide to trade it. Well, no. I mean, if you want to trade it in your trading account. Don't commingle everything, separate things. But I think over the last 50 years, 100 years, if you dollar cost average, it would have done marvelously for you. However, the ETFs have only come around last 15 years, 20 years, right? So, but today there's an ETF for everything, exchange traded fund. There's an ETF for Bitcoin even, right? So maybe you should be dollar cost averaging Bitcoin, which I'm going to talk about on the last subject. To me, it's the key to long-term nest egg building, long-term wealth building. You can't just go say, well, oh, look at NVIDIA, I'm going to buy it here, sell it here, because, a hummingbird, and you jump from flower to flower. It says there's a time and space for that, okay? But then, ultimately, long-term wealth is built by buying and holding by dollar cost averaging, okay? I mean, perfect example would be what? Warren Buffett, right? Now, is his style my style? Absolutely not. Right? Am I more of an active trader? Yes, I am. The reason for that is these benchmarks that people have created, such as the S&P 500 or the triple Qs, on average, they go up 8, 10, 12% a year. On average. There have been down years, there have been up years. But if you DCA, you're not going to worry about that. So my point is, most mutual funds out there, I would say a majority, maybe 90+% of mutual funds, cannot beat these benchmarks. So if you have like a 10% return, there is also something called Rule of 72, which you guys need to pay attention to. Rule of 72 is whatever return you're getting on your investment. It could be real estate, it could be stocks, it could be individual stocks, it could be ETFs. All you have to do to figure out how many years it's going to take for your money to double for that initial investment, and then the compounding comes into play, obviously, is you take the return that you're receiving, right? Let's say 10%. What you do is you take 72 divided by 10, and that's 7.2. That means every 7.2 years, that initial $100, let's say a month you put in, is going to double. There is no ifs and buts about it if you're receiving, on average, a 10% return. Now, think about it. The next month, every month, you're putting $100 away, $200 away, whatever you can afford, right? But start investing. That's the key. And a lot of people mix it all up. They go like, yeah, but what if the S&P falls, 30%? Yeah, it has happened before, right? But then, you guys must also understand what's happening economically, the bigger picture, obviously, the macro, the micro, and the most important thing, you guys have to understand that the Federal Reserve, which I've been talking about it endlessly for the last 2.5, 3 months since I started the channel, they cannot afford the market to go tank, right? Everybody's 401k, everybody's pension plan is in stocks. So what they do is when the tank happens, like it happened when? Last one, pandemic, right? 40%, 35% drawdown in the S&P 500 and the triple Qs. What did the Fed do? Fed starts the printing machines, and then they come support the market, right? So my idea about this segment is start investing. And for most people, your success is going to be, yes, there will be people, I'm one of them, that they will beat the benchmarks. But most mutual funds or most people cannot beat the benchmarks. And at a low cost, you can dollar cost average and, steady as you go. That's what you have to do. You have to understand long-term growth. Long-term wealth is built by patience and dollar cost averaging. Active investors did really well when hedge funds were coming around, right? It was new 20 years ago, 15 years ago, but then they would charge 2 and 20, 2 meaning 2% of management fee and 20% of your profit. Even today, hedge funds are having trouble beating the benchmark. So why not, right? Why not dollar cost average, start a little investment fund, investment account, and then continue doing the same thing. So with that said, please pay attention to the power of compounding and pay attention to dollar cost averaging. And you should do it religiously, meaning you put the $100 in every time at the same time of the month. You just go buy the SPYs or the QQQs or the IWMs or whatever ETF you think is good for you. You should do that.